In Chapter 7 of Locational Marginal Pricing, we will discuss economic decision making, particularly in the context of electricity markets. We'll look at construction operation, central planning versus markets, goals of decision making, central planning, and how well it measures up to those goals. Similarly for markets, the idealizations that are necessary for markets to achieve these goals, how that fits into competition in electricity, what ideal central planning would look like, and then bilateral contracts versus auctions. There's a homework exercise at the end. There are two aspects of economic decision making in the electricity industry. There's the investment and construction decision. When should we build? What type of generator, transmission lines, distribution lines, substations should we build, and where to build them? There's also scheduling and operations. Which generators to operate given their technical limitations and the technical limitations on the operation of the transmission system. This class mainly focuses on scheduling and operations, but we also need to keep investment and construction in mind, and we'll do that in this chapter. There are two extremes of mechanisms of how to make decisions in an economic system. At one extreme, there's central planning. A central decision maker makes all the decisions. And historically, this is the way that the electricity industry worked. For generation, transmission, distribution, system operation, and retail sales. At the other end of the spectrum, we have markets, where individual participants make decisions in reaction to prices. That's now in place in many countries for generation and retail functions in the electricity industry, and we saw how it might work in the market for apartments in the last chapter. When we think about making decisions, we need to have goals in mind. So let's try to set up a description of what would be a desirable outcome of an economic decision process. What's the right outcome? Well, we met in the last chapter surplus and maximizing surplus. Recall that that's the benefits of consumption minus the costs of production. And that's what we'll focus on as a goal of decision making. It's important to understand that that's not the only goal. Other outcomes, distributional equity, may also be desired. We're going to focus on maximizing surplus since it can be the natural result of a market action. But other desired outcomes, distributional equity, reducing pollutants, for example, requires explicit actions outside of the market, separate from the market, such as taxation. So, could we achieve maximizing surplus through central planning? Definitely we could. It would require all of the relevant information to be known by the central planner, and we also need to assume that that planner cares to achieve surplus maximization. Could markets achieve maximization of surplus? Yes, under ideal circumstances. In this case, we don't need a single entity to know everything. We have distributed information. The firms presumably know about their costs, would like to maximize their operating profits. Consumers presumably want to maximize the benefits of consumption, less the costs that they're charged for their electricity. Under appropriate circumstances, these motivations result in surplus maximization. The circumstances are not exactly satisfied in practice, but that ideal gives us a useful benchmark. So how would markets achieve this outcome? To understand that, we're again going to turn to optimization problems. We're going to imagine the problem of maximizing surplus, and here we will imagine a central planner solving the problem. There will be costs, benefits. We're going to maximize benefits minus costs subject to supply equaling demand. That's an optimization problem with a quality constraint. And so, under suitable circumstances, there'll be a Lagrange multiplier on the constraint requiring supply to equal demand. Furthermore, under suitable assumptions for validity of our sensitivity analysis, that Lagrange multiplier indicates the marginal cost of serving additional demand and the marginal savings if the demand decreases. We already called that the marginal surplus. So that's optimization problem number 1. Optimization problem number 2, actually a collection of problems, one for each firm, is operating profit maximization, given a price for sale of the production of that firm. Key observation in markets is that if prices faced by the firms are the same as the Lagrange multiplier or multipliers in surplus maximization, then the firm behaves consistently with surplus maximization. We've seen this actually in several examples. The bottom line is if the firms face the right prices, then profit maximization is consistent with maximizing net surplus. We say that the prices support efficient behavior by the firms. That applies for the supply side. It also applies to the demand side. Well, that works in an ideal market. And what do I mean by an ideal market? We need to make various assumptions in order that the prices are right. In other words, in order that they're consistent with the idealization of central planning. First of all, there have to be markets for every possible commodity traded, including markets for bads, such as pollution, so that there are no externalities that are not represented in the profit maximization of individuals. There need to be no economies of scale. There needs to be sufficient competition. And there has to be some process that adjusts and ultimately determines the market prices. Let's discuss those in turn. Externalities first. An externality occurs when there are costs imposed by the action of one participant on another or others. And under those circumstances, we generally can't rely on the market alone to provide the right prices. It implies a role of government to provide regulation or taxation to internalize the imposed costs. A classic example of this in electricity, a regulation of sulfur dioxide and nitrous oxide, SOx and NOx. A topical example these days in electricity is the potential regulation of CO2 using a cap and trade or a carbon tax. Next, economies of scale. Economies of scale means it's cheaper per unit installed capacity for larger capacity, or cheaper per unit production for larger production. The electricity industry historically was thought to have extreme economies of scale. They were so extreme that the industry was thought to be a natural monopoly. In other words, it was the case, or it was believed to be the case, that a single producer that built everything was the cheapest way to operate the industry. If there's only a single producer, however, there's not really any scope for competition or a market. And because that single producer has no competition to regulate their activities, we need another entity to step in to regulate the actions, the government, in fact. More recently, it's been realized that competition in the generation sector was reasonable, in fact viable. This is particularly the case for combined cycle gas turbines, because the minimum capacity necessary to reap economies of scale in building a combined cycle gas turbine is pretty small compared to the annual average demand growth in a large interconnection. The minimum capacity to reap economies of scale in wind turbines, similarly, is around a few megawatts. For a combined cycle, it's maybe a few hundred megawatts. But both of those chunks are relatively small compared to the demand growth in a large interconnection. So the idea is that several competitors could each be building new capacity needed for growth at the scale necessary to reap scale economies. So let's put that together with sufficient competition. If the industry is large enough that there could be several firms, each of which is large enough to reap economies of scale when they want to build something, but such that they are still small enough to be a small fraction of the total industry, then competition is likely to result in better outcomes than central planning. Why is that? Well, competition will tend to keep current prices low and will also encourage technological innovation to keep future prices low. In contrast, monopolies, and a single firm is called a monopoly, typically don't innovate strongly. So even if regulation keeps their current prices low, it's unlikely that they will innovate to produce technological innovations to keep prices on a low trajectory. Last element is price adjustment. In many markets, including the market for apartments that we discussed in the last chapter, we can assume that self-interested behavior by the market participants results in price adjustment. Remember the argument that if the price was above the market clearing price, the landlords would want to adjust prices up, for example. And if it was below, a renter who was not renting might want to then negotiate. So there's an adjustment of prices. We'll see that in the context of electricity markets, however, we need to set up a mechanism to determine prices from offers. And the reason is because of the fast pace of changes in demand in electricity markets. Nevertheless, electricity has been open to competition. The move to competition, at least in the generation sector, has taken place in many countries and many states of the US. Chile, Norway, United Kingdom, Sweden, Finland, Denmark, New Zealand, Australia. In the US, California, PJM, which means Pennsylvania, Jersey, Maryland, originally as an acronym but now extends to more states, New England states, New York, ERCOT, and the Midwest. And retail competition is also in place in some jurisdictions, UK and Australia, ERCOT, and several Northeast US states. Well, before we get to competition, let's try to understand central planning. And again, we're going to idealize it. Our goal is to understand in more detail how markets might achieve the same as ideal central planning. So we need to, first of all, understand ideal central planning. We'll first simplify to the case where at any given time the demand is fixed. In other words, it's inelastic. We're going to need to expand that analysis to include price-responsive demand having a willingness to pay. And as I'll emphasize in many contexts, price-responsive demand is very important in the context of electricity markets, and all markets, in fact, to inform the market about the need for capacity. So as I mentioned, we'll mostly be focused on operating existing generation. But here we're going to consider both operations and construction. And indeed, the incentives for building the right amount and right mix of generation capacity are an essential role for electricity markets. So we really can't just consider operations. We need to first consider the conditions characterizing how much of each type of capacity we need and how to operate it. Our idealizations will include various assumptions. For example, we'll ignore lumpiness of actual generation expansion and indeed of operation. In other words, we'll assume that new generation can be added in quite small pieces. We'll also ignore the fact that generation investments are typically sunk. That is to say, once you've built them, you've got them. We're also going to ignore uncertainties in demand, in fuel costs, investment costs, and the availability of generators, and we'll also ignore the effects of the transmission system. Many of these issues can be included. We're going to assume that capacity of a generator of type K can be rented. In fact, you typically have to build it, but let's pretend that we could rent it at some annual cost, RK. That would be denominated in dollars per megawatt year. It's somehow the annual capital carrying cost of owning the generator per unit capacity. And if we're paying dividend to the investor or some other profit to the investor, this RK should include that. For that type of capacity, let's assume that the marginal operating cost is CK. That's denominated in dollars per megawatt hour. We're going to ignore minimum and maximum capacity. We're going to assume that that marginal cost is constant throughout the operating range, and we're also going to assume that those generators are available in infinitesimal slices of capacity. Well, let's suppose we've got some generators of type K. Let's suppose they were operated at full output for TK hours per year. And for simplicity, let's assume they are out of service the rest of the year. So what would it cost us per year to own and operate it? Well, the operation would be RK, the capital cost, the rental on the capital cost would be RK. The operating cost would be the marginal cost times the number of hours that we rent it for. And again, both of these are divided by the capacity, or we can think of them as per unit capacity. So the total cost of operating for TK hours is RK plus TKCK. It's an increasing linear function of TK. We'll have different types of capacity. Let's suppose we had a type of generator K and another type of generator L, such that RK plus T times CK was less than, cheaper than, RL plus TCL. If that were the case, then we wouldn't want to build a generator of type L. At least if that would be the case, if that were true for all T. We would not want to build any generators of type L. So we're going to assume that the types of generating capacity of interest are not dominated by any other type. We'd only want to build ones that were undominated. However, if there are several types of capacity, then we need to choose amongst them. The optimal choice is going to depend on the time of operation and the relationship between costs. For simplicity, we're just going to consider two types of capacity, base load and peaker, but the analysis also works for more than two types. The basic insight is that a generator that has low variable cost, typically that'll be associated with high capital cost, and we might call that a baseload generator, a baseload technology. They're cheapest when we use them for more hours, relatively speaking. Whereas a generator that had low capital cost, which typically means high variable cost, high marginal cost, they're cheapest when used for fewer hours. The threshold occurs for an annual operating time when the total cost, the values of the total cost are equal. And for base loads and peakers, that threshold satisfies exactly when they're equal. I'll write TPB for that threshold. It occurs for the time TPB such that RP plus TPB times CP is equal to RB plus TP PB CB. That's easy to see on a graph. The curve that starts out at a high value of intercept, that corresponds to its capital cost, but a low slope corresponding to its marginal cost, is the baseload technology. The peaking technology has a lower capital cost corresponding to its intercept, but the linear function, increasing linear function representing its total operating cost, increases at a faster slope because of its higher marginal costs. Where these curves cross is the threshold, TPB. Most hours in a year, for a normal year anyway, is 8760. And so we're graphing the total cost versus the number of hours of operation per year. So let's consider the demand now over a given year of 8760 hours. For any particular demand level, we could ask the following question. How many hours in that year do we have demands that exceed that level? That graph is called the low duration curve, and it is the same information as a cumulative distribution function for demand. Here's a low duration curve. As you can see, at 0 hours, the corresponding demand or load is the load that is occurring for just momentarily. Other numbers give us the number of hours when the load is at or above that particular level. For example, down here at this low level, the minimum load for the year, all 8760 hours have a load at least that value. At an intermediate value, we would find that at this loading level, there is this many hours per year where the load exceeds that value. What we're going to do is divide up the load duration curve into horizontal infinitesimal slices. Each horizontal slice has a particular duration, and each slice can be most economically served by that capacity that's cheapest for the corresponding duration. For example, if that duration is longer than TPB, then we should use baseload capacity. If that duration is shorter than TPB, then we should use peaking capacity. So if my threshold is TPB, then this quantity of load should be served by baseload capacity. Why is that? Well, for each of the horizontal slices here, we can think of serving using that generation to generate either for the full 8760 hours or for some number of hours less than that, but each and every one of those hour durations that we're going to operate that baseload capacity for is out or longer than TPB. On the other hand, for serving this fraction of the load, the time that the load's going to be at or above that level is less than TPB. We want to use peaker capacity for that load. So that tells us how much base load, how much peaker capacity. Analysis using the load duration curve and the cost of capacity is called a screening curve analysis. And the basic analysis suggests that we would build enough capacity to meet all of the demand. That's consistent with the assumption of fixed demand at each time, having an arbitrarily large valuation of the benefits of consumption. However, let's now suppose that there's price-responsive demand. In general, this would mean that at each time we need to associate it with a demand curve. To make things simple, however, we're going to simply assume that at each time demand has a fixed willingness to pay W for levels of demand D up to the previously assumed level of demand D overline that we could read off the load duration curve for that given time. W might be a bid demand, or it might correspond to the disbenefit of involuntary curtailment. We call that the value of lost load. If the supply is higher than that, there's no willingness to pay for additional demand, however. So we could think of the demand curve at a particular time corresponding to the quantity D overline desired at a given time from the load duration curve. So there's different ones of these for each time throughout the year. And for this quantity, the willingness to pay is W. We can also describe the benefit function for that, the benefit of consumption for a particular time. The benefit versus the quantity, it has a slope which is equal to the willingness to pay, but once we hit D overline, there's no more benefit of additional consumption. We can think of the benefit as the integral of the willingness to pay. So let's reinterpret the low duration curve using this notion of willingness to pay. We should reinterpret it as showing the desired demand at a given time. If the price is less than W at a particular time, then the desired amount on the low duration curve is consumed. If the price is more than W, then the consumption would fall to zero. It could be anything between that level and zero. If the price is more than W, then the consumption falls to zero. If the price is equal to W, however, then the consumers are going to be indifferent between consuming and paying W or not consuming and paying nothing, so the consumption is going to be between zero and the desired amount, D overline, on the low duration curve. So when we have price-responsive demand, what should the capacity be? Let's consider a slice of the low duration curve of length T that is pretty near to peak demand. So if it's going to be supplied, it should be supplied by the peaker. With price-responsive demand, the willingness to pay for this energy is TW per unit capacity. So if we serve a slice of length T, the load or demand is going to receive benefits TW per unit capacity. But what does it cost to operate and build capacity for meeting that demand for that length T? Well, we'd have our annualized investment cost, RP, plus T times CP. Well, we should only build capacity and supply the demand if TW implies benefits that are greater than the costs. On the other hand, if TW is less than RP plus TCP, then the benefit of consumption is simply less than the cost of supply. Surplus maximization tells us we should simply not supply that demand. We'll notice that as T gets smaller and smaller and smaller, at some point RP is going to dominate the equation. So this observation that we should not supply all the demand is going to be true for some sufficiently small value of T. In fact, there'll be some threshold, and that threshold will be defined by TCP times W is equal to RP plus TCP CP. That would occur at some typically small number of hours, and for those hours, instead of building peaker capacity, we should curtail. So that was the idealized central planning in principle. How would a market achieve this outcome for both operations and capacity? We're going to need to consider the equilibrium prices. Let's first assume there's some fixed or given amount of base load and peaker capacity. And as in our central planning type example, we're going to imagine infinitesimal slices of generation and slices of demand that can be bilaterally traded at particular times. Really, we'll be using a similar example to the apartment example. In practice, we can't quite do this in electricity markets. So let's consider a particular time when the desired amount from the low duration curve was less than the base load capacity. There just simply is less demand than the base load capacity. So not all of the base load generation could be operating. Any generation that actually occurs incurs a variable or marginal cost at least VB. So the price will be at least VB. Let's suppose that a demand paid more than VB. But then we'd have some generators who would like to operate, in fact, who would like to undercut this price. So that means in equilibrium, the price has to be exactly VB. Desired consumption is going to occur. Now let's consider a time when the desired amount on the low duration curve, D over line, was more than the base load capacity, but less than the sum of the base load and the peaker capacity. All the base load generation is going to be operating, but not all the peaker capacity is going to be operating. Any generation incurs at least marginal cost or variable cost CB, and if any peaker were paid less than CP, it would shut down. With a bit of argument, we can show that the equilibrium price is exactly CP. Furthermore, let's consider a time when the amount on the low duration curve, the desired load, is more than the base load plus peaker capacity. Not all the consumption can occur. The price has to be at least W, but if the price were above W, no consumption would occur. So the equilibrium price is exactly W. Consumption would exactly equal. It would be curtailed down in the case of curtailment, or voluntarily restricted down to a value that equals the sum of the base load and peaker capacity. Well, what about the transition cases, when the desired consumption exactly equals the base load capacity? Actually, any price from CB to CP would be an equilibrium price. On the other hand, if the desired consumption exactly equals the sum of base load and peaker, then any price from CP to W would be an equilibrium price. So long as these situations occur fleetingly, the actual price doesn't matter. Of course, it only occurs fleetingly. Typical market rules and implementation, however, will generally fix a particular choice in the range. Here's our price duration curve. For the hours when there's curtailment, the price will be W. For the hours when the base load and the peaker are operating, the price will be CP. Of course, when there's curtailment, we'll be meeting the rest of the demand, and the base load and peaker generators will operate. But along this region, the peaker and base load is enough to meet the demand, and the price will be CP. Then, for these hours, the price will be CB. Let's go back to our central planner problem and consider surplus maximization faced by the central planner at a particular time. They want to maximize benefits minus operating costs. Remember, we formulated that problem. There's a Lagrange multiplier and power balance, and that gives us as part of the solution of the optimization problem. In fact, it would equal the prices we've just calculated. In the cases where there's a range of equilibrium prices, there's also a range of possible values of Lagrange multipliers, and indeed the software will generally come up with a particular value. How much capacity is actually going to be built in a market? Those equilibrium prices were for a given level of capacity. In an ideal market, the amount of capacity is going to depend on whether or not there is profitable entry of new generation. And the way to think about this is to imagine starting with zero generation capacity, meaning curtailment all the time, and let's calculate the profit obtained from building capacity and selling energy. And we'll assume that new construction occurs until the profit of additional entry falls to zero. Well, I claim that the amount of capacity built by the market exactly matches the optimal levels under central planning and has the same prices. How am I going to show that? By showing that there'll be zero profit for additional entry when the level of capacity is at the right level. So let's recall the central planning. We have curtailment for duration TCP, base load at full capacity, peaking supplying the rest of the demand for duration TPB minus TCP, and base load supplying the demand, peaking not operating, for duration the rest, 8760 hours minus TPB. How much capacity is going to be built? Let's consider three cases. Let's suppose that we had exactly the right amount of capacity, meaning the same as the optimal centrally planned capacity. The second case, we'll consider the case where there's less, and then the third case will be more. Let's suppose base load and peaker capacities were equal to the optimal central planning capacity. What would the prices be? Well, we'd have prices W for duration TCP, CP for duration TPB minus TCP, and prices CB for the other duration. Given capacities equal to the optimal central planned capacity, let's consider a peaker operating for a total time T. That time T is between TCP and TPB. What would be their revenue? Well, they would get paid W times TCP, there for the hours when there's curtailment, plus CP times T minus TCP. Adding that together, because of the relationships, we find that that's equal to RP plus TCP. In other words, that's exactly the total costs. So the generator is exactly remunerated for their total costs. They just break even. No new additional entry would occur. How about a baseload generator? It operates for less than or equal to 8760 hours, more than TPB hours. The revenue of the baseload per unit capacity is given by, they get paid W during the hours of curtailment, they get paid CP during the hours when the peaker is running, and they get paid CB for the hours when the base load only is running. Using our previous result from the peaker capacity, we can write that in terms of RP and CP, but then we can, using our relationship for the threshold time TPB, we can rewrite that in terms of RB plus CBT. Again, the revenue turns out to be the same as the total costs. So the base load just breaks even. On the other hand, if we had less than the right amount of capacity, for example, if the price is W for more than the optimal duration TCP, the peaker revenue would exceed total costs. We'd get new peaker entry that would tend to reduce the curtailment duration towards TCP. Similarly, baseload entry would be profitable if the duration of prices above baseload operating costs is more than enough to cover the capital carrying cost of the baseload. Third case is if the capacity is more than the centrally planned optimal. Then the price will be low. Price will be of W will occur for less than the optimal duration TCP. Peaker revenue would not cover total costs. In principle, in our rental story, peakers would exit the market. Curtailment duration would increase towards TCP. Similar argument applies for baseload. In general, generators are sunk, as we've discussed, so the owner might just wait until demand increases if they had built too much capacity. That's something that we saw more or less in the first years from about 2001, 2002 onwards. We had too much combined cycle capacity. Those generators stayed around and waited for demand to grow in ERCOT. So, to summarize, in an equilibrium of capacity and operations, the amount of peaker and baseload capacity is exactly sufficient to achieve optimal duration of curtailment. The conclusion is that market prices will induce the optimal capacity and operations. However, something that's absolutely important here and crucial is that we need curtailment. Demand needs to set the price during curtailment. That typically is not a very attractive circumstance, so we can modify that a little bit. An alternative to curtailment could be for the demand to set the price as part of a voluntary choice not to consume. These arguments can be extended to include uncertain demand and supply. Entry will then occur in response to expectations about future prices. There may be a risk premium paid. The uncertainty in future prices can be reduced through longer-term bilateral contracts. That could include future and forward contracts, as we discussed in Chapter 6. We'll discuss this further in Chapter 11. What about W? How big is it? Historically, before the advent of markets, most demand was exposed to a single price that stayed fixed over extended periods of time. And in this circumstance, curtailment is unsatisfactory because there's not really an option to charge a time-varying demand to that demand. Given a fixed price, in fact, adjusting demand involves involuntary rolling blackouts, or must be in response to a public appeals to the public to conserve. And in this circumstance, we typically think of W as being very high, on the order of thousands, many thousands of dollars per megawatt hour. And if we plug that into our typical costs, the resulting duration of optimal curtailment is very small. And there's a traditional rule of thumb of 1 day in 10 years. Sometimes that's modified to be 1 event in 10 years. With changing market prices, however, an opportunity to respond, it's likely that many customers could be willing to voluntarily forego their consumption at relatively lower prices. However, most initial electricity market designs have not included mechanisms to elicit willingness to pay from demand. Example in ERCOT is that ERCOT nodal allows demand bids in the day-ahead market, but not in real time, which sufficiently limits the ability of load to participate in the market and to be asked the question, are you willing to voluntarily forego consumption? Unfortunately, without knowledge of demand willingness to pay, we need to base estimates of optimal capacity on indirect measures. And that's quite problematic in the ERCOT nodal market and indeed every market. Every electricity market. Incorporating more demand responsiveness is an absolutely important goal for all electricity markets, particularly in the realistic case of demand uncertainty. Moreover, even in restructured markets such as ERCOT, involuntary curtailment is typically not politically acceptable. In other words, that duration needs to be restricted to a very short time. And furthermore, in addition to delivering energy, ISOs also procure ancillary services. And under those circumstances, the focus of curtailment is typically not on literally tripping demand, switching off demand, but rather having less than the full levels of ancillary services, procuring less than the full levels of ancillary services. We'll talk about how to implement this in a so-called demand curve for reserves in Chapter 8. The idealized market that I described implicitly has bilateral trades between generators and consumers. However, this is not realistic for a short-term electricity market. As we'll discuss further, the total supply-demand balance needs to be maintained by a system operator. That necessitates that real-time dispatch and pricing is determined by the system operator rather than by purely bilateral trading. That's accomplished by an auction. Bilateral trades are common in longer-term contexts. They could be scheduled into the day-ahead market, for example. They could range from hours to decades, and they have an important role in providing collateral to obtain finance to build new generators. But in Chapter 8, we're going to focus on auctions for short-term electricity operations. So in summary, we've discussed construction and operation, central planning versus markets, goals of decision-making, central planning, markets, market idealizations, competition in electricity, ideal central planning, and bilateral contracts versus auctions.